All right, so in this video, I want to talk about 3 bearish trades you can make if you think the stock market is going to drop. So the first trade that you can make if you want to bet against the stock market, or if you think the stock market is going to drop, is you could short a stock. So basically what that means is you can sell shares instead of buying them. So normally everyone's used to buying shares, buying stock, and then selling them when they go up. But you can also do the opposite. If you think the stock market is going to drop, you can actually sell shares first, but it doesn't end there. When you sell shares, you get the money for selling the shares that is deposited in your trading account, but you also have a negative 100 shares, or a negative, regardless the amount of shares you sell. You've got a negative amount of shares in your account and you have to close it. You have to buy it back to close the trade. So the idea, if you think the market is going to drop, the idea is you're selling the stock high and then you're buying it back later at a lower price. That's the plan. But if things don't go your way and the stock goes up, then you're going to have to buy it back at a higher price, and that's how you could lose on this trade. In fact, the loss on this trade is unlimited because the stock can go up to almost any price. So you don't know how much you could lose, and it's really it's not capped, it's unlimited. But your max profit is capped. Best case scenario, the stock goes to zero. So your max profit is basically the price at which you sold your shares. So I'm using the example of the SPY here. Right now, the SPY is trading at around 305. So if you wanted to short stock, you could sell shares of SPY at 305. That money would be deposited into your trading account. And as the stock drops, you'd be making profit, and you decide when you want to buy it back, confirm the profit. But if the stock goes up, then you're starting to accumulate losses, and who knows at what price you'll have to buy it back. Personally, I don't like this trade for 2 reasons, because basically you have to predict the direction. I don't like predicting the direction. I only make money if the stock moves a certain way, and the loss is undefined. It could be unlimited losses, so that's scary. It's not something I can handle. The other thing I don't like about it is there's a borrowing rate. So when you sell shares first, you're borrowing shares from the broker, and they charge you for that. And if you look at the quote, you can see there's a section here called borrow rate. Now every stock's gonna have its own borrow rate, and sometimes the interest rate is very high. Now with Questrade, you definitely need a margin account to short shares, and you probably need at least 25k equity in your margin account to be able to sell shares. Now the other trade you can make if you think the stock market is going to drop is buy a put option. So this is not stock involved. This is simply buying a put option. So you're basically betting that the stock market is going to drop. So how this works is you could do this in a TFSA, in an RSP. All you need is level 1 option trading, and there's a lot of flexibility. So if the stock is trading, let's say we're talking about the SPY, it's trading at 305, you could decide to buy a put option at a 295 strike, but you could also buy a put option at a 300 strike, at a 305 strike. You could even buy it at a 310 strike. Really, the difference will be how much you're going to pay in premium to buy that put option. So the more out of the money the put option is, the less you'll pay in premium. The more in the money the put option is. So if it's trading above 305, then the put option is in the money and you're going to be paying more in premium. But the advantage of buying an in the money option is that your break even will be smaller. So if you buy a 295 put and the SPY is trading at 305, let's say you pay $5, let's say, depending on the contract that you take, on the expiration that you get, a 1 week expiration, you could take a 30-day expiration, 6-month expiration. It's really up to you. But let's say for example purposes, you take 30 days and you pay $5 for it. So basically your break even at expiration is 290. So the SPY needs to be trading at 290 come 30 days for you to break even on that put option that you bought. Anything below 290 starts becoming profit. But of course, you don't have to wait till expiration. Let's say you buy the put option today for $4 at a 290, for $5 at a 295 strike, and the stock right away starts to drop. Well, that $5 increases in value right away, even if the SPY currently is not trading below 295. Let's say the SPY was at 305 and it starts dropping to 303, 302. Your $5 option is going to increase in value. So if you want, you can sell it and make a profit. But in theory, to break even by expiration, SPY needs to be trading at 295 minus the premium that you paid. So minus $5, for example, then the SPY needs to be trading at 290 for you to break even. If it's trading at 280, then you just made a $10 profit per contract. One contract represents 100 shares. So if you buy one contract and pay $5, then you're actually paying $500. But then if you sell that contract for $15, then you just made $1,000 profit. Now, if you decide to buy a put option at a 310 strike, for example, while the SPY is trading at 305, you'll probably pay maybe $10, but then your break even is only 300. So for you to break even, you need the SPY to trade at 330 days. So it's a safer trade, but it's got less return on capital, because if the SPY is trading at 280 in 30 days, your put option will be worth 310 minus 280. So it'll be worth $30. You paid $10 for it. So you made a $20 return on a $10 capital. Now, the most you can lose on this trade is whatever you paid to buy that put option. That's the max you can lose no matter what. So there is a max loss. It's not unlimited like shorting a stock. And the profit, there is a max profit. Basically max profit is achieved when the stock reaches zero, but it's unlikely. But the profit potential is very high. So you can make double or triple or even 10 times your capital if you really get the direction right, and if the stock moves in the direction that you want very quickly. So this one has the highest profit potential, but it's the one that is least likely to win, because you really need three things going your way. You need to get the direction right. You need the stock to move by a certain amount, which is a strike minus the premium that you paid. And you also need all that to happen within a certain time frame. So you need three things going your way to actually make money with this trade. If you get them right, the potential for profit is very high. Now, this falls in the same category as buying a put option. So I'm leaving it in this as the same trade. It's just an extra element added to it. It's called a put debit spread. So it's the same thing. You're buying the 295 put, but in addition, you're selling the 290 put, same expiration. The advantage of doing that is it reduces how much you're going to pay to buy the put option, because let's say you're paying $5 to buy this put option, but you're selling a 290 put option, so you're collecting money for that. So whatever you're collecting here, you can use to pay part of the put option that you're buying over here, but you also cap your profit. So your profit is capped, or your max selling price is capped at the difference of both strikes. So the difference between both strikes is $5. So if you paid a net debit of, let's say, $2.50 for this put debit spread, regardless of where the stock is, even if it's trading at $5 or even $10, the max you can sell this put debit spread for is $5. Your return on capital would be $2.50 divided by a $2.50, so 100%. So it helps pay for your put that you're buying, but it also caps your max profit. So that's the extra element in this trade. Now, to trade a put debit spread, you need to have level 3 options trading with Questrade. And I think that requires a $5,000 minimum equity. So if you wanted to buy a put with Questrade, basically buying a put just requires level 1. So basically you look up the option, SPY for example, and right away you've got calls and puts. You choose the expiration that you want. So let's say you want to go till July 17. You pick the expiration, and then you've got calls on this side, you've got puts on this side. So if you think the market's going to drop, you're going to go on the put side, and basically you can choose the strike that you want. So see, the higher the strike, the more you're going to pay, but the safer the trade. The lower the strike, the less you're going to pay, but the unlikely you're going to win. So by default, Questrade shows you 9 strikes, but you could click here to show all strikes. And for example, you could go and pick a let's say 280 strike. You can see that the 280, you'll pay $5 for it for the July 17 expiration. So if you do that, if you buy this put option, for you to win, or for you to break even at least, you need the SPY to trade at 280 minus $5.28. So you need the SPY to trade at around $274 by July 17 for you to just break even. Anything lower than that becomes profit. But between now and expiration, if the SPY starts moving lower, quick enough, you can actually make a profit by selling your put option before expiration. Now, a put debit spread is a vertical. You could choose the same expiration. You're going to go on the put side and basically just click anywhere, click buy and sell, and then the order entry window updates automatically. So you can do the same thing. So you could decide to buy the, let's say the 280. You could decide to buy the 280 put, but I'm going to sell the 275 put to help me pay for that put option that I'm going to buy at 280. So the 270 put that I'm selling, and this is obviously after hours, so this just shows me the last traded price. So you can see that to buy the put option is going to cost me $5.28, but I can sell the 275 put option for $4.48. So I'm going to pay a net debit of about 80 cents, but that means my max profit or my max selling price of this trade is going to be $5. 280 minus 275, 5-point wide. That's the max that I can sell this trade for. So my max profit will be $5 minus 80 cents times 100, because one contract of an option is 100 shares. So the advantage of this trade is to help you pay for the put option in case things don't go your way. At least you didn't lose the full $5.28. Now the other trade you can make is to sell a naked call. So this one's a little bit similar to shorting the shares, but it involves options only. And you've got some flexibility because you can actually choose the strike at which you sell the call option at. So when you sell the call, you're going to collect a premium. You're going to collect credit. And basically for you to win on this trade, you need the stock to stay below the call strike that you chose by expiration. So if you choose the July 17 expiration and you sell the 310 call on the SPY, for you to win on this trade, the SPY can trade anywhere below 310 and you will keep the premium that you collected. But there is unlimited loss. So you could lose, you don't know how much you can lose. If the SPY rallies to 330, 340, then you're going to lose $40 times. If the SPY closes at 340, for example, by July 17, you're going to lose 340 minus 310, which is $30 times 100. So you could lose $3,000 if the SPY rallies to 340 by July 17. So of course it's unlikely, but in theory your loss is undefined, it's unlimited. And what's great about this is you can control how safe you want the trade to be. You don't have to sell the 310 call, you could sell the 320, the 330 call, making the trade safer, but of course you're going to be collecting less premium. Now your profit is your profit is capped, and it is actually known. Your max profit is what you collected from the premium to begin with. That's the max you can make from this trade, is the initial premium you collected from selling the call. And sometimes you can even close the trade early instead of waiting for expiration. So you're going to buy back the call option to close the trade. So to close this trade, actually you have two options. Either you buy back the call option for less and make a profit, or you let it expire worthless at expiration. And for this call option to expire worthless, it has to trade below 310 by expiration. Sometimes you don't want to take the risk and wait till expiration. If you sold, so if we look at an example here with SPY, so I'm going to look up SPY under options. I'm going to go to calls and puts, July 17 expiration, but this time I'm going to choose calls, and I'm going to choose all is already chosen. And let's say I want to sell the 330 call, for example. So you can see that the 330 call is trading for about $1.11. So I'd collect, if I do one contract, I'd collect $111. If the SPY stays below 330 by July 17. And if anything, I can always close the trade early as time goes by. The value of the premium drops in value. If the SPY stays at 330, goes down, or time goes by. But my max profit would be $111. I can get closer. I could sell a 320 call and collect $309. I can go to 310 and collect $7.22 times 100, so $722. But then the trade is riskier because I'm only 6 points away from the current market price, and who knows, maybe the market will rally. And finally, the last trade you can make if you are bearish on the stock market, or if you think the stock market is going to drop, is a call spread. So it's similar to the call. So I put it under the same category, but it's a call spread. So instead of just selling a call, you're also buying a call. So if the SPY is trading at 305 right now, and you think the stock market is going to drop, what you could do is sell that call like we showed in the previous example. So I've got the colors reversed here, but if you're selling, it should be red. So you can sell the 310 call, but then buy the 315 call for protection. And what do I mean by protection? I mean, remember we said that if the SPY closes at 340 come July 17, I'd be paying $30 to close a trade, 340 minus 310. Well, by buying the 315 call option, it caps my loss. My max selling price or my max buying back price would be $5. So I would never have to buy it back for $40 or even higher if the SPY decides to skyrocket. So I'm capping my loss. So let's go see Questrade to see an example of what I could get with this type of trade. So with Questrade, it would be a vertical. So I just click on vertical call. And then I would pick my expiration, July 17. And we said that I would sell the 310 call. It was just for example purposes. I'm not saying that this is a good trade. So 310, and I'd buy the 315 call. So I would collect $7.22 by selling that 310 call, but then I would pay $4.85 for buying that 315 call option. So the difference, it's a net credit. That's what I would keep. That's my max profit. And I keep that profit as long as the SPY trades below 310 come July 17. But in the worst case scenario, if the SPY is trading above 315 come July 17, then the max I will lose is $5 minus the credit that I received initially. And the credit that I received initially in this case is $7.22 minus $4.85. So about $2.40. So that means my max loss is about $2.60. Worst case scenario times 100. So $260. But my max profit is about $240. That's if I wait till July 17, and that's if SPY is trading below 310. So between the three trades that I showed you, my favorite would be the call spread because it gives me room to be wrong. The SPY is trading at 305 and I think the market's going to drop, but I could be wrong. So if I sell a 320 or 315 call spread, the SPY could go up a little bit and I could still make money. But as long as it stays below my call strike chosen, then I'm fine. Wherever it goes lower, I make the same amount of profit. So I like this trade because it gives me more room to be right. Yes, the profit is capped, but at least I know what my profit is. I know what my max loss is, and I've given myself a good chance of winning. But if you're looking for the trade that gives you the most profit, so the one that's more of a gamble would be buying the put option because you can make a lot of profit this way if you get everything right, if you get the direction, the timing, and the amount right. So going back to Questrade, to sell a naked call alone, it requires level 4 options and minimum 25K equity in your margin account. But if you do a call credit spread, it's level 3 options with Questrade and just requires 5K equity in your margin account. So these were the 3 most popular bearish trades you can make if you think the stock market is going to drop. So if you have any questions, leave in the comment section below. I'll gladly answer them. And if you are going to open an account with Questrade to trade on the stock market, use one of my referral codes below. One of them gives you up to $250 back, depending on your deposit. The other one gives you $50 in free trades, regardless of your deposit. And if you enjoyed this video, click the like button, share with a friend, and subscribe to the channel. Thanks for watching.